Okay, let's unpack this. We are diving into the Q3 fiscal year 2025 earnings call for Chewy.
That's right. It hit the wire pre-market on December 10th.
And the market reaction was, well, kind of all over the place. A huge pop at the open on some really strong beats, but then a pretty big fade during the day.
And that volatility is exactly what we need to get into. For you, the listener, the mission here is to cut through all that noise, all that short-term trading, and really answer the big question.
What'd you say?
Is Chewy actually making the turn? Are they transforming from, a cyclical e-commerce stock into a predictable high-margin subscription and pet health platform?
The market clearly couldn't decide. But let's start with the numbers that got everyone so excited in the first place.
Yeah.
Profitability. They crushed it.
Absolutely.
Adjusted earnings per share, which is the number everyone really watches for operational health, came in at 32 cents.
And consensus was only 30 cents, so a solid beat.
More than solid. That's nearly a 60% jump year over year.
Yeah.
I mean, that is just jaw-dropping.
And even on a gap basis, including all the other stuff, it was strong, 14 cents. It shows real discipline.
Okay, so what about the top line, revenue?
Revenue hit $3.14 billion. That's up about 8.3% year over year, and it just nudged past what analysts were expecting.
A slight beat there is nice, but here's the part that really stood out to me. Management made a point of saying this growth was driven almost entirely by unit volume.
Not by price.
Exactly.
And that's critical. It means they're not just hiking prices in an inflationary world.
Yeah.
They are actively taking market share. They are selling more stuff to more people.
Which brings us to the customers. The active customer number grew for the fourth straight quarter. It hit 21.16 million.
Just a little ahead of the 21.05 million the street had penciled in. So you look at all that, and the initial take is just, wow, strong execution, customer growth is back, and profitability is exploding.
So why the fade? Why does the stock give so much of it back? The answer, I think, has to be in the durability of what they're building.
Exactly. That's the structural question. And the foundation of that whole structure, that whole economic moat they're trying to build, is Autoship.
The subscription business.
Right. And those sales grew 13.6% year over year to $2.61 billion.
Let's just pause on that number for a second. $2.6 billion.
And what's really just astonishing here is that Autoship now makes up 83.9% of their total net sales.
84%.
Think about that. When 84 cents of every dollar you make is basically pre-sold via subscription, it just changes everything. Inventory, logistics, cash flow. It all becomes so much more predictable. It fundamentally de-risks the business.
It's the Netflix model for pet food. You're selling predictability. But does that actually translate into better margins? Because subscription alone doesn't guarantee profit.
It absolutely does, and for two main reasons. First, the sales mix is getting richer. Gross margin expanded by 50 basis points to 29.8%.
Okay, so 0.5%.
Which is huge at this scale. And it's happening because of that Autoship volume. Plus, they're selling more high-margin stuff like pharmacy and other pet health products.
And you said there were two factors. What's the second one?
It's the scaling of their other revenue streams, mainly sponsored advertising. As Chewy gets bigger, brands like Purina will pay more to be at the top of the search results.
And that ad revenue.
It drops almost straight to the gross margin line, very little cost associated with it.
So you can see the leverage building. And where did all that flow down to?
Straight to the adjusted EBITDA margin. That's their best measure of pure operational efficiency. It hit 5.8%, up a full 100 basis points year over year.
A full percentage point?
And that discipline generated $175.8 million in free cash flow. That's real cash they can now use to, buy back shares and fund their own big projects without taking on debt.
I'm going to go back to the customer for a second, because it's not just about getting more of them, it's about getting better ones, right? Yeah. Net sales per active customer was up almost 5% to $595.
Right. And how are they doing that without raising prices? Well, they're getting much, much better at marketing. They're attracting what they call high-quality customers.
So they're not just blanketing social media with ads.
Not at all. It's targeted. It's data-driven. They pointed to a 15% jump in orders coming from their app and double-digit gains in SEO performance. They're capturing people who are already looking for what they sell.
People who are more likely to stick around.
Precisely. And that's why their profitability is growing faster than their sales. They're leveraging the customers they already have more effectively.
Okay, let's pivot from optimizing the core business to pure innovation, because this is where the future growth story is. And here's where it gets really, really interesting for me. The Chewy Plus membership program.
This might be the most important signal in the whole report. In late October, they raised the price for Chewy Plus Fist. They took it from $49 a year all the way up to $79.
That is a huge jump, a 60% hike. You'd expect a lot of people to cancel.
Analysts certainly did. They modeled for a big spike in churn, but it didn't happen. Churn was significantly better than they expected.
Huh. So people see the value.
They see the value. 80% of members are now on that paid tier, and those members are already delivering gross margins at the same level as the entire company. The program is working. It's getting people to buy more often and to buy more of the high-margin stuff like toys and treats.
That pricing power is a huge sign of a strong brand. But Chewy Plus is still about selling things. Their biggest bet, their biggest structural shift is the whole health ecosystem strategy.
Right. Moving beyond just products and into services, pharmacy, tele-vet, and now physical vet clinics, Chewy Vet Care, or CVC. That's where the real long-term compounding is supposed to come from.
So let's talk about those CVC clinics. They only have 14 locations open. I mean, is this really moving the needle, or is it just a high-cost experiment at this point?
It's a fair question. But the early data they shared is really compelling. The clinic's performing better than expected, and here's the crucial part. They're acting as a powerful customer acquisition channel.
How so?
They said that 4 out of every 10 new customers walking into a CVC clinic are completely new to Chewy. They've never bought anything from the website before.
Wow. So the clinic is the front door to the entire ecosystem. You bring them in for a checkup and you turn them into a lifelong Autoship customer.
Exactly. It totally changes the math on the cost of building these clinics. It's a marketing expense that pays for itself.
And they're getting more specialized too, right? I saw they're acquiring a company called SmartEquine.
Yeah, a strategic move into the high-value world of horse health, and they expect that deal to immediately add to their adjusted EBITDA margin. It just reinforces that health services are becoming the main profit engine.
Okay, so it sounds like smart spending. But I remember a while back, investors were worried about cash burn, especially around their fresh food launch. Did they talk about that?
They did. And it was a really key clarification. They made a clear distinction between what they called temporary costs, like that food launch, and structural investment.
Yeah, the difference is?
They promise that going forward, their big spending will be on things with clear long-term ROI. Think fulfillment automation to lower costs and building out more health services. Everything has to meet a strict payback threshold.
Which brings us to the big disconnect. All of these structural pillars look incredibly strong, but the stock still got hammered intraday. It all comes down to the guidance. So what does this all mean for you listening?
It really all boiled down to the Q4 forecast. For all the good news in Q3, the guidance for the next quarter was, well, conservative, and the market hates conservative.
So what were the numbers? What did they guide for Q4?
Net sales guidance was $3.24 to $3.26 billion. Now, that's still 7 to 8% growth, which is solid, but it was just a little bit shy of what the street wanted.
And the earnings guidance was the real issue, I take it.
That was the bigger miss. Adjusted EPS guidance of $0.24 to $0.27. The consensus was at $0.29.
Why the shortfall? What was the reason?
A couple of things. They flagged about $10 million in one-time closing costs for that SmartEquine deal, which hits in Q4. And they also just signaled a bit more promotional pressure around the holidays.
So the market hears cautious outlook and sells.
Pretty much. The short-term caution just overshadowed the long-term structural story, at least for one trading session.
But looking past Q4 into 2026, they still sounded pretty confident.
They did. They expect the macro environment to be pretty much the same as 2025, slow growth. But they still affirmed they'll keep taking market share and keep marching towards their long-term goal of a 10% adjusted EBITDA margin, which is a huge target.
A very significant target.
So the perception is split. The stock traded at 3 times its normal volume. There is massive interest. But investors are rewarding the structural story while also being really skittish about the near term. They're still testing the durability of this transformation.
Which brings us to our "this is not financial advice" segment.
Let's hear it.
Okay, so you have this amazing tension, right? You have incredible long-term structural health being punished because of some short-term conservatism. What's the outrageous but plausible trade idea here?
I'm ready.
The trade is this. The market is fundamentally mispricing the stickiness of that new $79 Chewy Plus program and the power of the CVC clinics as an acquisition funnel. It's pressing structural compounding like it's cyclical retail noise.
That's the disconnect we've been talking about.
So the trade is a high-conviction, long-term bet. You buy long-dated, deep-in-the-money call options, like 18-month calls. You're betting with the big money that piled into options right after the call.
You're betting that the structural improvements will eventually overwhelm the short-term noise.
Exactly. You're betting that by the time those calls expire in 18 months, the combination of fulfillment automation, marketing efficiency, and the health ramp-up will have accelerated margin growth so much.
That it forces a major re-rating of the stock.
A major re-rate, one that pushes the stock way above current analyst targets, maybe north of $48 a share. It's a patience trade, a bet on compounding over cycling.
A fascinating way to play the thesis. And to bring it all home, the thing you should really be monitoring from here is the central theme. The shift to an integrated platform built on subscription and health is not just happening, it's accelerating.
They're building a fortress around their business.
They are. All the data, from the 84% Autoship to the price elasticity of Chewy plus FA, points to a high-quality compounding asset in the making. But the market is still treating it like a volatile retailer.
And the final provocative thought for you to take away is this.
Which narrative is going to win out in 2026? Will investors finally start valuing Chewy as the structural platform it's becoming? Or will they keep getting spooked by every conservative quarterly guide? The answer to that question will determine everything.
Something to think about. Thank you for joining us for this deep dive. We'll see you next time.